Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. Well, I don't know if I can touch this today, man. There's crazy shit happened overnight. Okay. Let's come to the charts. You got to remember that, like, I do a lot of reading while I'm getting ready. But when I come here and I do my run through of all the instruments, what I'm showing you is me seeing it for the first time. So overnight, there was a little bit of Japanese yen intervention, shall we say. There was also a move by the British Central Bank. And you can see, I mean, look at these charts down here, man. That is nuts. This is a 64-point move up and then back down and then up. This is that is too volatile to trade. I think that is too volatile for me to trade. We'll see. I also didn't get to sleep at a very good time last night because the toddler rather, was being a total brat. So maybe it's better for me to sit on the sidelines. So the big thing on the British pound though was that they started buying. They did QE again. They capitulated. They said we're going to do some QE. So that's what's causing this big move in the overnights in interest rates. And in the short term, that probably does kind of stabilize markets a little bit. And so, yeah, I think probably the right trade is to the long side. It's just that the liquidity sucks, and this looks like this is just going to be really volatile. Okay. Oh, by the way, we are going to get wholesale retail inventories here in about 3 minutes while we're going through this. All right, now S&P 500 took a little bit of a dive too overnight because Apple kind of revised some of its numbers. I forget the exact headline, but basically bad news from Apple. Okay. Oil, well, that's interesting. Oil is bouncing a little bit. And natural gas is going down, which is really interesting to see natural gas going down with all of the craziness over the Nord Stream pipeline. But you got to remember that these are U.S. prices. So silver and gold moving up a little bit. That might actually make sense given the currency uncertainty. Copper kind of following the dollar as well here. So come over. Bitcoin did finally give it up yesterday. That's still just back to the bottom of the range, but Bitcoin did give it up yesterday. And the dollar, new highs. It's not like an insane new highs or anything, but and like the dollar's not coming back yet. Not yet. I think we could see some movement on that during the day though, right? So I don't know. We'll come over here. It's not that I don't know. We'll see. We'll see, right? Now, when I'm looking at the 10-year, big thing to note here is that we are at 3.9. So, like, despite the big push up, this is just like a retracement of the previous day's move. It's just a really violent retracement. I don't know. I don't think we ever touched 4%. We didn't quite touch 4%, which is... Okay, Pablo, the coupon code for Jigsaw. What? Again? Oh my gosh. Okay, hold on. Let's. So last time I did this, and I went to Jigsaw, and Pete was like, "Nah, I think it's fine now." And I'm like, no, they fixed it before you looked at it. I promise you it doesn't work. It didn't work. I promise you it didn't work. So let's come over here. Oh wait, we gotta pause this. I opened it up so I could find it. Okay. Yep, I'm seeing what you're seeing. I'm gonna fix it, bro. We're gonna fix it. Okay, let's see here. So let me open up in a different browser. I'm gonna open it up in a different browser to prove that it's not just the browser. Okay. Joel, good morning. Hey, is that a new name? But welcome. And good morning, D Lightning too. Okay, so we fixed that. So Pablo, I sent it to Peter, so we should have that sorted out today. All right. Hopefully today. Sometimes he's on a different time zone. Okay. Let's see here. Brannigan Barrett, 1 minute ago. So the markets punished the UK for lavish spending and tax cuts. The Bank of England then steps in and increases holdings on its balance sheet, effectively increasing debt, promising to neutralize when things calm. The markets are not stupid. Parity will come fast and soon. Ooh, is he saying that the pound is gonna get pounded? Well, there was like when the news happened, there was like a big move up in the British pound and a big move back, and then there was a little move down, and now we're kind of retracing it a little bit. I don't know. I think, whoa, there was a 45. Ooh. Okay. This is why I don't think I can trade it. Granted, if I had gone short here, I'd probably be up like 5 ticks, right? But they just busted through a 5,000 lot iceberg at the top. That's, This is wild. I mean, it seems like we're pretty chill about it at the moment, right? But this is actually, I'm actually like terrified to trade it with a live account. No joke. I'm genuinely terrified to trade this with a live account, even though I think that it's going to go up. In fact, I'm really confident. We could do it on sim, I guess. I'm really confident that this is going to continue moving up. Like I can just sit here with bids. That's fine. Okay. Feeling, are you asking if I'm feeling confident or are you feeling confident? Like, see that? You're going to see that. The problem is just the pullback is going to be like 16 ticks at some point. Right? Joseph Wing tweets, looks like gilt investors are learning this today. Oh, wait. This is a larger thread. Okay. The great financial crisis occurred in part because what investors thought were safe assets were not actually safe. The inevitable losses led to a large deleveraging, which led to more losses. The government then declared only sovereign liabilities could be safe assets and mandated many to hold them. Sovereign liabilities have no credit risk, but they can also experience significant price declines and maybe even suddenly, like safe AAA private label mortgage-backed securities can. This would also inflict large losses on investors and could prompt more deleveraging and losses. Looks like gilt investors are learning this today, says Joseph Wang. Yes. Yes. The song that's playing right now, well, it just changed. It's all stream beats. Everything that you're listening to and the music, it's always stream beats, okay? So this one is Virtual Soul, but what was the one before that? No, go back. Golden Age. Golden Age. We'll just listen to it again. It is pretty. I'll like it so that it will be more likely to play again in the future for us, okay? This one? Golden Age or the one before that? Yeah, Golden Age. There you go. It's got kind of a bit of a ragtime kind of tune to it. See, look at this. Okay, look, it pops off. They come back on me. This is exactly why I'm not trading it live. I know it too well. Yes, Zia, and I know you too well now. I know how you love to screw me over on that one. Right? And if I was trading my live account right now, I would be like, well crap. I think I better preserve, you know. I better like scratch it. And then they'll immediately jump up to the high again. Look at that. So see? Do I know? Look. But you know what I love is that I understand why, right? You create such insane movement just creates really massive liquidity holes. And the issue is kind of like, so when I was averaging into the position, the reason I did it the way that I did was because I said, well, it looks like there's a liquidity hole here. So I can kind of take this. I'll take one here and then the rest here, and it should run. If it runs, it falls back to the liquidity hole. Great morning. Well, look, I'm already up $600. No, I'm just kidding. Anyways, this is where the liquidity hole can kind of be to your advantage, right? Because the liquidity hole kind of limits the downside a little bit. If it fails, then you're going to get the reversal, and that really sucks, okay? But you can get this pop off, it slides back into the liquidity hole, and comes back up. And like if I was, you don't really want to take it when it's popping off. Unless you're going to be really fast. At least in this action. At least in this action, you got to be careful about chasing it. Because you create these liquidity holes behind you. So the question is, though, where should Sept take profits? How about 112? $112 is maybe a little too aggressive. Oh, look, it's gonna pull back again. Some very aggressive volume behind all of this as well. But look, if a central bank is buying, you know, if a central bank is buying bonds out there, you do not want to be selling bonds, right? So we need to dive more into what's happening a little bit, right? So first thing I want to point out, the zero hedge story for this, okay? Their headline is the Bank of England capitulates, restarts QE due to significant dysfunction in the bond market, material risk to financial stability. Liquidity holes are great places for break and pullback scenarios. Yeah, exactly. Well, like, especially going into the high, is that what you're likely to see is British, and then it like practically comes all the way back. And then you have to sit down and you have to say, okay, is there more to come? Well, if a central bank is buying, probably. So then maybe you can buy it when it falls back in the hole again, right? But that doesn't mean that there's necessarily less risk in there. It kind of makes it a little bit easier of a location for you to try and play and minimize your risk. There's still that chance that it just utterly fails, right? Because if somebody comes in and takes the opposite trade, you're gonna get burned so bad, right? Otherwise, if you're taking as she goes, like the thing that I've learned when you're taking as she goes, if there was a liquidity hole below you and you're taking as she goes, you've got to take your profits quick. Because I guarantee you that's going to pull back at least a few ticks. Okay, anyways, where's the part that I wanted to know? Okay. The bank became the first bank to capitulate on its plans to proceed with quantitative tightening on Wednesday when the central bank restarted QE in an temporary and targeted bond buying operation, which, and this is their comment, will be as temporary inflation was. The bank warned of a material risk to UK financial stability. If the turmoil in the UK government bond market were to continue, it also raised the prospect of tightening of financial conditions and a reduction of the flow of credit to the real economy. According to the Financial Times, so this is the part that I want you to pay attention to, okay? This is the part that kind of made me go, According to the Financial Times, the break in the bond market manifested itself in thousands of pension funds have faced urgent demands for additional cash from investment managers in recent days to meet margin calls after the collapse in UK government bond prices blew a hole in strategies to protect them against inflation and interest rate risks. So let's go back to what Joseph Wang said. The great financial crisis occurred in part because what investors thought were safe assets were not actually safe. The inevitable losses led to a large deleveraging, which led to more losses. The government then declared only sovereign liabilities could be safe assets and mandated many to hold them. Sovereign liabilities have no credit risk, but they can also experience significant price declines and maybe suddenly. This would also inflict large losses on investors and could prompt more deleveraging and losses. Looks like gilt investors are learning this today. So, what happened? According to the Financial Times, pension funds were losing so much money from holding gilts which were supposed to be as a protection against recession and inflation, I guess. And those are falling so hard right now that the pension funds were going to have to put up more liquidity. And if you're a pension fund, I mean, think about it. You're a pension fund and you have to sell assets to continue running. You're a pension fund and you have to sell assets to avoid a margin call and continue running, right? That's a disaster for markets, and that is where like a systemic a complete system-wide deleveraging like we had in 2008, that's how something like that starts. Oh, totally. And the Bank of England said, we can't let that happen, and they stepped in. Okay. So, question number one. Does this stabilize the markets? I think at least in the short term, it does. You're buying, if they're buying in the short term, probably stabilizes things. And I'm having a hard time searching for words here a little bit. I really didn't get enough sleep. Okay, in the short term, probably it does stabilize things to some extent because again, like from a trader's perspective, if the Bank of England is going to be buying bonds, I don't want to be selling them. Okay, and there's probably lots of speculators and stuff that were going short the gilts and everything that are getting their asses handed to them today, right? Tobias, you'll see more and more central bank interventions if the dollar keeps climbing. Yes. Okay, so here's the problem. Number one, will this stop the dollar? Look at it this morning. Does it look like it's backing off? Like if we were down below 113 and a quarter or something like that, then I'd be like, hey, maybe it's over. Maybe the dollar's going to stop doing this crazy stuff and it's over. Maybe it's, but right now I don't think I can say that. Yeah. I think you're finding it, a good thing, right? And then the other thing is like, so if that doesn't happen and the markets continue to have pressure on them, then what does the Bank of England do next? Like they're saying this is just temporary. Like what happens when October 15th comes along, right? Does the market go right back to what it was doing and it hurts you again? Like if I'm George Soros, okay? If I'm George Soros and I think, oh yeah, there's a ton of money that I can make here, and I may even be able to influence the political situation in the UK because of this, because that's what I mean. I don't know if he's doing anything, but that's the way that guy works, right? It's all reflexivity and that sort of a thing, right? So you're shorting the bonds and making the interest rates rise really hard. Okay, cool. You're making money. And then the Bank of England says, we're going to restart quantitative easing. What do? You puke. You hit the puke button. Well, he can't hit the puke button, but you get out of that position, right? But George Soros is probably also saying, well, I made money on that move and I can completely get out of my trade and then just go short again in 2 weeks. Yeah? That concerns me. Question number 3, though, is, okay, so what if the United States is put in the same situation? Interest rates continue. Let's just assume for a moment that this is not the lows in bonds, that next week or something that bonds push lower and we get interest rates above 4%, if not 4.25%, 4.5%, because these analysts like Nomura are saying that the neutral interest rate is higher now and that they're going to have to push interest rates like above 5%. Okay. Would the US capitulate as well? And what would be the consequences of that? Because if the bonds do continue moving down, that means that inflation is still not tamed. So you're going to come in and start buying bonds when inflation is not tamed yet? You know what I mean? Like that's not a good situation. So like I'm sitting here and I'm like, okay, short term, probably we buy it here today. Although obviously, as you can see here, how it's working out on my sim trade, it's too wild to trade. It's too wild for me to trade live. Okay, but in the short term, probably we buy bonds here. But what happens in 3 weeks, 2-3 weeks? Like what happens in the midterm? I am now, you know, it's rough when you know that your emotions are getting involved in everything. But like in the past, often when we come into some of these crazy markets, I kind of feel like I understand what's going on and I have opinions about what's going to happen next and I can stay calm. But today I feel a great deal of anxiety for what the markets may have in store for us over the next 6 months. I already thought all these pension funds are screwed more than stock investors. Well, there's lots of people that are screwed. Let's just put it that way. But like that's the whole thing. At what point does the Federal Reserve have to capitulate? Not because they have tamed inflation and are creating a recession and now they can back off, but because they have to step in and do something. Otherwise, the entire market is just going to completely fall apart. David, good morning. How are you? Andre, what are you saying is Nancy Pelosi? Did you so you remind me, I know this is like a tangent, but can I rant about something real quick? A bill is materializing. She's screwed. Well, she's not going to be. She's not screwed. No. Well, she's not going to be Speaker of the House anymore. I can tell you that. So they're putting together a bill to prevent trading from members of Congress. And from what I recall, they were saying that like they were tightening up the requirements. So you had to submit your transactions digitally and all of this other stuff. They were also putting limits on like who could even own assets. But the penalty for not doing it was $1,000. I was like, you realize that there are members of Congress right now that are breaking the rules and just paying the fee, right? Come on. Isn't that a freaking joke? Like seriously, it's a freaking joke. She paid it cash, bro. That's right. I have to say she has made some good trades. Like I like when I look at Nancy Pelosi and everybody's saying, well, she's doing insider trading. Well, yeah, but her husband also really knows what he's doing. Okay. I'm gonna bet that he could probably do pretty okay even without the inside information. The inside information is just the cherry on top, you know. He knows what he's doing, man. Just a little rant. Just a wow. I got 17 likes on a tweet. Too bad none of those people followed me. I forget who's Nick Ball. I don't remember. This guy has commented on my post before. I don't remember if he's somebody that follows. Oh, no, he's somebody that follows me. Yeah. Okay, cool. Oh, he's from Utah. That's cool. So Taleb was arguing with somebody about COVID or something, and I said something about COVID. I don't know if I really want to talk about it here. I don't want to go down that segue, but apparently people liked it. People liked what I said. So that's cool. But none of you followed. Twitter drives me crazy. Okay. Okay, Mohammed A.L. Arian. The inherent optimism of U.S. stock markets is evident as the Bank of England's intervention is seen as pointing to a more dovish Federal Reserve. Thoughts? Question mark, question mark, question mark? Right? That's the question, right? Here's my thinking. Here's my thinking. I'm going to speculate like super hard here, okay? Jerome Powell is a conservative guy and he will prioritize price stability. So he will not do anything that will he will prioritize fighting inflation first. And he will not, because like, man, what happens if you come in, you say, okay, there's like the market's crashing. So now the Federal Reserve, we changed policy, right? So like normally you'd say like in 2008, market's crashing. Oh, okay, well, yeah, we need to lower interest rates and everything because this is going to be like a severe deflationary impulse in the markets and everything else like that, right? But what happens if you're already getting significant inflation and then you have a big market crash, right? And can the Federal Reserve then come in and say, okay, well, I guess it's safe for us to lower interest rates now and everything because we're going to get a big deflationary? No, I don't know about that one. Because like the inflationary pressures are still there. And if you do that, then all of a sudden you risk getting what? Hyperinflation, right? So I think that Jerome Powell will stay steadfast in the face and that there is going to be a lot. If it really goes down that way, you know, they were saying, will the Federal Reserve be able to like stay strong when people are like protesting outside and shit? I'm starting to think that might be what happens, yeah? We'll see. What do you guys think? Are you buying any? No. So you know what, Andre? I have so I have a little stock account, right? And I put a bunch of cash in it. And I did buy some things. And a couple of those investments are like way underwater. The overall portfolio's made money and has done better than the market overall, but I had a tech stock in particular that just got creamed. Wish I could have taken some profits on that some bit, but you know, I was always saying like probably it's better for me to just not touch it, you know, and so maybe I should have been more active. But the problem that I have is if I start being more active, when do I say when I should be active or not? Because I probably would have made more moves than I should have, right? But the thing is that I always felt, I said this from the very beginning of the COVID crisis that like, well, yeah, them coming in and doing stuff, that's definitely going to move the market and everything. And it looks like we're going to have like a really, you know, a really crazy bull market here while the money tap is on, but in the long run, you're going to have to pay for it a little bit. And this is unsustainable. So I never spent it all. So I still have a decent wad of cash. I spent a little bit of it back in June or July, and I bought Berkshire Hathaway with it. So I bought something that I thought was really conservative. But I didn't buy all of it. Didn't spend all of it. So I still have cash. And it looks to me like I hold that cash a little longer. The Fed has never raised rates when earnings are negative. I think that they will stay the course until something breaks in the credit markets or earnings. Well, but that's the question though, Scott, is will the Federal Reserve pivot if something breaks in the credit markets, even if there are signs that inflation is still a problem? That's the question, right? And I am speculating that they will keep raising rates, and they'll say, tough guys, you shouldn't have you should know better that even bonds go down in price sometimes, and you're all just screwed. I really think that's what it'll do. It's really speculative. I don't know if I feel confident enough in that call to put money on it, but that's my speculation at the moment. Do you think they will pause the rate hikes? Okay, so let's put it this way. Let's see if we can game this out. I need to look at the calendar here a little bit because I think that in this kind of scenario, the calendar matters a little bit, right? So I'm gonna come in here. This month I think I can do. Yeah, and then I'm going to only have the US and inflation and central bank. Okay. So oh, okay, yeah, and then we need to go to next month. We need to go to October. Okay, so we get CPI on the 13th. Okay, and then actually really what we want is November, huh? November. Oh, FOMC is November 2nd. We could game it out with November. What about December? Nah, let's do it December. Okay, so let's say that it is December. Okay, it is December 9th, and core PPI comes out, and it is 0.8. Okay, so like PPI is 0.8. Okay, interest rates rise, etc., and something breaks. This move, when the interest rates increase, some pension fund or whoever it is, they're like screwed, and the credit markets start to fall apart, okay, because of a high CPI print. Does Jerome Powell not increase interest rates in December? That's kind of the scenario that I'm trying to paint, right? It's like you've had a clear indication that inflation is still out there and a problem, but you can see a real problem in the credit market. Does he back off? And because the issue is that if you back off, if you start doing QE or you start doing something right, hyperinflation. That could cause hyperinflation, I think. I think that they still increase rates. And they just say, well, it's going to be really painful for the markets, but we're not going to allow hyperinflation. Or our mandate is not to support asset prices. Our mandate is to support maximum price stability. You get what I'm saying? Oh, we have somebody speaking right now. Who is that? Past performance suggests they continue their plan. Sure. I mean, let's acknowledge here that I have to paint a really dire scenario like that, because the reality is that the current situation is so much more fuzzy, right? Like, some people believe that we're already in a recession. Some people believe that we've already tamed inflation, that inflation is going to peak and that it's just lagging, and that they know it's already peaked because leading indicators suggest that we're in a recession, right? All of these sorts of things. If there's a break in the credit market, that kind of suggests that a deflationary wave is coming in, that sort of a thing. So like, real scenario is going to have a lot more question marks in it. But don't assets rise when the Fed does QE? Well, yes. So if this, so again, like if we had that scenario happened, right, and it was like, bonds are crashing because PPI was still really, really high, And then the Federal Reserve made the surprise call of, well, we think that we're having a recession and that we don't really have to worry about the short-term inflation. And so we're not going to raise interest rates next month, or we're going to start QE right here or whatever. You buy it, man. That's on that one. If that was that would be like the craziest thing that will ever happen in markets in your lifetime, if that's what happens, right? That's the craziest thing that ever happens in your lifetime if that's what happens. And at least the knee-jerk trade on that one is to buy treasuries, right? The knee-jerk one on that is to buy treasuries. Now the problem might be that the dollar might like completely collapse in that situation, and then hey, you'll make a money. Like you'll make like thousands of dollars on your treasury trade, and it's like the greatest trade ever that ever happened, and it won't matter because dollars are worthless. But hey, at least you made the trade of a lifetime. or you just buy gold, I guess. I don't know. That one I really don't know. Like I said, when I started, this is where I'm at today, right? Is like when I start gaming out some of the possible scenarios from all of this, it's a little scary to me. It's a little scary to me. I feel a great deal like a move like this. Oh, I'm not gonna put it in Bitcoin. Are you kidding me? Okay, let me think about that one for a second. Like it gives me anxiety, man. It really does. A move like this should be like, oh, okay, the central bank is stepping in, everything's good, we can buy the dip, etc., 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 right? Makes me nervous because I know, like, short term, yeah, maybe it's okay, but like the UK says this is only temporary, so like they could say, okay, we're done. That they really could just, you know, not do anything when they're specified, because they gave like a date. They gave a date, so the date comes and then they don't renew it, and then things go crazy again. You know, like sell your dollars for Arab currencies. Good, but well. Okay, so when I think about Bitcoin, so like again, the issue with Bitcoin is that Bitcoin is unsuitable as a currency. So the whole thing about Bitcoin could be a hedge against fiat currency collapse or something like that. Well, maybe that would be possible if number one, it wasn't deflationary itself. But more importantly, number two, you could actually use it. I mean, there was a time when you could actually use Bitcoin. Now you can't. Like retailers got screwed on it so much, and it's so slow that it just doesn't function. So I think that in any kind of a crisis with Bitcoin, you have these possibilities of like deleveraging and people taking their money out of it. Like seriously. Like it's not that you're dead. Like I think that you're dead wrong. It's like, oh no, you're dead wrong, and I would short Bitcoin in that situation. No. I'm just saying I wouldn't feel safe with my money there. Right? I think that if there was really was a move like that and the dollar was no longer safe, that the place to go would be gold and silver. Nothing is more permanent than a temporary, right? I like so to the comments in the Zero Hedge article that like it's probably not temporary, and that when that date comes when they're supposed to stop their quantitative easing and whatnot, that they will like renew it and push it out again. That one I'm almost willing to bet money on. Yeah, that one I'm almost willing to bet money on. But the issue on that one is that might not be enough. If you're getting in November and December and you're still getting high PPI prints, then that's not going to be enough. I'm gonna take a few bites here and let's think. I keep talking, guys. Keep talking. So here's something else we should talk about here. Okay, if I had taken that trade that I took here in the sim account, okay, I had taken it over here in the treasuries, I think that we were like at 8.9, 389. Let's just say it was 389. Okay, I think I could have made like 30 or 40 bucks, which, considering how wild that move was, is actually not that great. But yeah, I would have made money. The pullbacks on it would have been really insane. So I am just like, I think that part of my anxiety today is that I'm just having like flashbacks. Like, I can remember during COVID, like before, when COVID was just starting, because maybe this is just the start of something much crazier, right? When COVID was just starting, I remember making money on like short ES as you know, things would go down and then it came back because it's like, well, it's not in the US and all that. So you remember all that stuff? And then I don't remember what it was, but there was like one day where I just made like a really bad series of decisions. And so I wasn't really trading it when we were getting like those limit down days and everything. Although I probably shouldn't have been trading it on those limit down days either. So there's probably many places where I would have blown an account. And then I wasn't really able to use my account during the beginning of the summer of 2021 when I did really, really amazingly well, and I had to do that all on sim. So I think that I am like, you know, I'm having a trauma response here where I can see where this is done. I see liquidity has gone back down below 1,000. And so I'm like, even though I'm really confident which way it's going to go, I shouldn't do this live. So I could have YOLO'd and I didn't. So the question is, YOLO, yes or no? Ask your community. That's the poll. The poll is up. Should Seth have YOLO'd? Okay, do you use any of your indicators in your day trading? What do you look for, e.g. on the resting orders indicator? Good question. Okay, so on the resting, so the ones that are specifically for order flow, David, I made those specifically for machine learning purposes. So what I was doing with those things is I was quantifying things that I regularly see on the DOM. Okay, so in particular, things where like something happens with a large order, a shift in the balance between the buyers and sellers, like you're talking about with the resting orders. But I was also, so that was a big part of it. That's like how it started. But then I was also kind of like, well, you know, like people will stack and then pull and stack and pull, and the amount of liquidity that they're putting on there is not really actually how much there is. And so I was like, okay, so what if you say, what is the maximum that you ever see stacked, and what is the minimum that you ever see after they've pulled? And that's kind of what the part of what the resting orders indicator is trying to do. Okay, so I would say, like, I don't have that indicator on a chart right now. I see it in the DOM, and it's just something that I kind of notice. And you know, those indicators were really built to be like, okay, you should be able to go and, or at some point I will. I'm working on some machine learning stuff so that I can take those indicators and see if there are some real consistent properties about them that we can tease out of them. Okay. But when it comes to my indicators the ones that I rely on the most, the ones that I'm really like, I can't trade without them, and I don't understand how people do, is my synthetic dollar index is number one, and my spread charts is number 2. Okay. The other thing is so on the new set of indicators, there's a couple of other ones in there that I've been using a lot. So one that I find really useful on the S&P 500 is the pulled prices indicator. So the pulled prices indicator is basically like you're trading on the S&P 500 and like price like slumps down. Like maybe we move, well, like what if we all of a sudden we sold from 36.64 all the way to 36.62, and there was some prices in between there where no contracts traded, like all of the bids just completely pulled, and so it moved through that price without anything trading on it, right? That's what the pulled prices is trying to detect, and those locations, from my observation, are extremely likely to become liquidity holes and will be visited over and over again. Okay, so that indicator is great. Another one I added in there was just the ATR. So like if I come over here to these charts right here, a big thing about markets, one of a lot of the proven empirical behaviors that we have to do with more with volatility rather than price is going to move up and then down and do all these sorts of things, right? And so ATR is a really good measure of volatility. The issue is just that the ATR that we get is kind of difficult to like put into real terms for you, because we think in terms of like ticks or in terms of like percentages and that sort of thing. So it allows you to change it between those, so that the ATRs, this is telling me right here how many ticks. So we've already overnight had a range of 91 ticks. Isn't that crazy? Right? And it also adds a moving average on there, which is really useful. Okay, so that one I really like. I know that that's not like a super complicated indicator, and probably a lot of people could write it, but it's so really very useful. Okay. The other one, it should be in there at least. I think I added another version the other day, and it's in there. Is market order imbalance. Okay. And that is the indicator that I was using for my robot. And we saw that robot make some really well-placed trades. So I think that you probably need more than just that one indicator. But like if I was buying, when I go back to my machine learning and everything, that's probably where I'm going to start, is with that indicator as kind of a basis for a trigger. Yeah. So there's a couple of things about my indicators, but I think what I need to do is I need to make like a short little PDF that is like the strategy and how I would use the indicators, like the most important ones. Because when I come in, what I'm looking for is predictors of order flow, breaking news, correlations. There's 5. Oh, order flow, local order flow, and risk management. Those are the 5 like pillars of the strategy. Okay. And so like having the spread charts to see which way the spread is going, the dollar, and looking at the correlations, those are the most important parts, right? And then the order flow part, you can get the order flow part from my indicators, but I get it from the DOM. Okay. And the indicators were really created, the order flow indicators were really created in an attempt to try and quantify what I do on the DOM. The 5 pillars. Yeah, I would say that the 5, should I call them pillars? The 5 necessary parts of a trading strategy, in my opinion, is predictors of order flow, breaking news, correlated assets, order flow, risk management. Yes. Okay. So David, I haven't updated the documentation yet. I've been lazy and I haven't gotten to that yet. I think I'm gonna take Friday off from work, and I'll be able to work on it then. Like I will record a video and then I will write the indicators. But I'm pretty sure that I did update it. So you should see them in there. Like here's the thing. For the, especially like the resting orders one, well, not okay, so resting orders is a good one, but the most complicated one is the inventory cost basis, right? That indicator is really, really complicated. And so really the documentation was mostly made for that indicator, right? Most of the other ones, I feel like, you know, but you put it on a chart and you watch it and you get a general idea of what it's about. So, and I'm totally down to, you know, I think now that we've got that part, so I think what I want to do is I want to spiff up that documentation and make sure that everything's all set perfect. And then I want to try and have like a Ninja Trader webinar, get some more people in. And then once we got some more people in, and also get you in on the Discord, probably need to do something on the Discord so that people that own the indicators can automatically get, because now that we're not doing it through YouTube, I think I would have to, yeah, I don't know how I would do that. Anyways, I would like to get more people in Discord, but basically at that point, once we got more people in, then we can get into like user requests and stuff. You know, I've kind of gone through a period where I've kind of avoided anybody talking about user requests because a lot of the things that people want me to write are like wastes of time. You know what I mean? But I think that this winter I might come into a period where I can spend that time, so it's okay, right? So, you know, if we make some indicators and it makes the indicator package more attractive to people. I primarily just want, you know, people to have these few little tools that I think are necessary, like primarily the dollar index and the spreads and stuff like that. Hey Jeremax, how you doing? I feel like, you know, like the thing is that's kind of hard for it with me is that I think that $100 is really generous for what you're getting, right? I think that especially that spread indicator is like really sophisticated now. Like most people with what's in the newest version of the spread indicator, most people would be charging like $400 for it, okay? I've had to do some tricky code in that thing. But in order to like, so it's totally worth the value, but the question on my side is, okay, but how do you present it to people so that they understand, oh yeah, like I really need to get this indicator package, like it's really going to make a big difference to my trading and stuff, right? Because I'm always going to be coming in here and giving you like all of the nuances about it and stuff, you know, like, okay, well, those order flow indicators, I don't have any clear edge or setup signal that you get from it. I created those and wanted to put them out so that you guys could try writing your own robots with them and seeing what happens, or, you know, just having them up on your charts and forming theories about them that we could maybe investigate. That's the primary reason why those are in there, right? But that's why I think that what I need to do is I need to come in and like, here is these strategies, like a little PDF that's like, here are all of the elements that you need to have, and here is where the indicator suite that I have assists you with those. Yeah. What are you saying here, Kyle? Speaking of volatility, I'm using options to set parameters on my targets and stops. I mean, for ES, you have VIX, but we don't have it for oil. I just get the ATM vol and nearest monthly option divided by 16 times the current price. And I divide by. Okay, so I didn't show you this, Kyle. Dude, this is crazy. So I don't know if you've ever heard of Garch. Garch is well, you know what? It's weird is that everybody puts it out as like them trying to predict how much, you know, what tomorrow's move is, but really it's an estimate for volatility. is what it really is. So there was an article that Jean-Philippe Bouchot has been promoting a lot called Volatility is Mostly Path Dependent. Let's see if I can find it here. Where did you go? I need to sort this by date modified, maybe? I swear I saved it. Maybe not. Maybe I saved it under one of these subfolders. There it is. Yes. Okay. So I think you could write this, or I think I'm going to write this and include it in the indicator package. So I have like the VIX, the volatility projection, or but that kind of relies on a VIX to make an estimate. So what if you don't have that? So now I think that we could be able to do this, and we could just add. You could just add on on a daily chart. Now there is some machine learning in here. So if I scroll down a little bit, let me make this a little bit bigger. I know this is like a big tangent from what we're talking about, but the market scares me. Okay, just stick with me here. Okay, this is like really valuable information I'm getting, right? You can output. Yes. So Scott, the thing that's so cool, the thing that I did, again, this is one of those things that like other people would be charging you like several $100s in just one indicator for it to do this. But the thing that my indicators, those order flow indicators do in particular, that's unique, is that they save their output to a file and then pull it from the cache. So if you add it to a chart and then you like refresh the chart or you restart NinjaTrader, you will still see the historical data from when you had your trading platform active, right? Because there's no way to do that. I mean, there's like tick replay, so you can do that for like order flow indicators. But when you're talking about level 2 stuff, like things that are showing you statistical properties of the depth of market, there's no way for you to call that data historically, right? So as it's doing it, it writes it to a file. So if you go into your NinjaTrader cache folder, you will find the files, and they're in comma separated files. So that means you can put the indicator on a chart and, leave it going every day. It will make a new file every day. And then at some point in the future, you could come back and load all of the data into Python, for instance, right? Isn't that cool? Jomo, the joy of missing out. What are you trading? We're trading treasuries, which are just going nuts. So I that's funny you call it the joy of missing out. I came in and I said, you know what, this market is too volatile to justify me trading, and it sure did play out. But I have a really confident idea of where the treasuries are going to go today. I mean, the central bank is buying. You buy, right? It's just I didn't think that I could hold the stops, so I didn't take it live. This is a sim trade, but you can see on the sim trade, not bad. And it might keep going today. Okay, I digress. I got like way too distracted. So here's this article or paper. Okay, so I'm going to show you. Let me come way down here. Where's the charts? Come on. No. Too far. Now, like the thing that's so cool about it, Scott, is that I have pieces of code that recognize what the data series are and automatically export, so that I don't have to specify it all and stuff. So it's really cool. I wish that I had a little bit more flexibility in terms of like putting in a like making it a framework so that you could use it to make your own indicators. But I think that when I put it into a DLL, that a little bit too much is hidden from you to, like, you might still be able to program it, but it's kind of hard to do it. Okay. Okay, yeah, that's the test and train set. That's not quite the one that I'm looking for. Oh, here it is. Okay. So here you go. This is volatility is mostly path dependent. So they came in and they made a model and they trained it on a test set, which was like 10 years, right? So it's like from 2019 to, oh no, this is the real set. This is the real set. Okay. The test set goes up to 2019. It's like from 2008 until 2019 or something like that. So it's like 10 years of data. Okay. Now look at this scatter plot though. Like look at how good of a line that is. So this is like the y-axis is what their prediction was, and the x-axis is what VIX ended up being that day. And look at how accurate it is to predicting what the VIX will be for on the daily basis. That is really good. And then they come in and they say, okay, oh, this is on the test set right here. This is what it was on the training set, and this is on the test set. So like, it's pretty damn good, right? You don't have any, you only have like one really huge outlier where you know, the VIX ended up being, the volatility ended up being much lower than anticipated. There's only like one outlier there. Oh no, actually that's not an outlier. That's just, they're just showing you, it's just a legend. Okay. So anyways, the point is the model performs really well. The model performs really well. Okay. And then you can come down into all of these ones and you can kind of see how it actually really performs on like predicting what the realized volatility is. Okay. So what do we mean by path dependent? Yes, good question. And they explain that in the beginning. Okay. So stochastic volatility models view volatility as an extra stochastic process driven by its own sources of randomness. Okay, so that's basically saying like there's a certain amount of volatility to the VIX, and then you know you add that, and then you come to the, right. That's like a stochastic model, right? In some sense, while stochastic volatility feeds the volatility level in the asset returns, path-dependent volatility does quite the opposite. It feeds returns into volatility. Oh, sorry. Oh, yeah, no, they didn't explain that. The implied volatility and future realized volatility depended on the path followed by the asset price in the recent past. That's the sentence I'm looking for. The implied volatility and future realized volatility depend on the path followed by the asset price in the recent past. Meaning that what the VIX is today depends largely, when I say largely, like 60% of it depends on how it moved yesterday and how it moved the day before and how it moved the day before. So how do they do that? How does this model actually work? Well, they have here they have this model DST over ST, which is the change in volatility is equal to the volatility, what is that? Omega drives the dynamics of the asset price S. There is a feedback loop from past prices into volatility. And DW is Brownian noise. Okay. And so they come in here, and then there's a bunch of this stuff, and then they're going through like what a stochastic model will look like. And then I think okay, so here's where they start getting into it. No shit. I mean, what does VIX do after a 3% move in ES? We already knew that. Yes, we kind of did know that, but it was like, how do you quantify it in a model, right? So here's what they do: is they say there's this K1 is a convolution matrix. Okay, so I didn't know what a convolution matrix is. So my understanding of what a convolution matrix is this is like something that you do in machine learning, where you say, okay, go and do the train set and tell me what the best values to use are. And it comes down in here and they show you a graph of the convolution matrix. Where is it? Right here. Here's the graphs of the convolution matrix. So they're basically saying, okay, if it's only been a day, then the value that comes out of the convolution matrix is 3. And if it's been like a whole year, then the value that comes out of the convolution matrix is practically 0. Okay. It is fitting data. That's what they do, is they fit the data on a training set, and then they see if that continues to work on a training set, or sorry, on a test set. They train it. There's a train set and a test set, right? That's why there was 2 charts before we were showing, okay, so here's how well it seems to work on the training data, and here's how well it seems to work on the test data, and it still worked really well on the test data. Okay, so that's a convolution matrix. But that's the important thing there, is that it's saying, okay, yesterday we used 3.5. So if we come back up to here to this little equation, so it's saying take the change from yesterday, and times it by that convolution matrix, right? So today you get like yesterday's return times 3.5, and then you'll get 2 days ago return times 2, and 3 days ago return times, and you do all of that for all of the days going back a whole year, and then you take the average of that, essentially, is how they get this one particular thing, right? And then they have another one. Other examples of trend features include the weighted sum of negative parts of the past daily returns. So they come in and they only say, what was the negative amount of return on that day? Like, what was the maximum drawdown from the open or something like that, right? And then you pass that into a convolution matrix, right? And that's basically how they do it. And then from there, so you these are basically features, is what they call them, right? Trend features, activity features. Okay. Activity or volatility features are features that capture recent volatility in the asset price regardless of its trend in order to learn volatility clustering, i.e. the fact that periods of large volatility tend to be followed by periods of large volatility. Okay. Right? So you get these different parts, and then you come in and it's just part 1 plus part 2 plus part 3, essentially, right? So they kind of do that, and they compare it to some other models and stuff like that. And then further down here, where is it? They like do one that, now they do it in a Markovian. Okay, so now they come in and they say, what if we did this with a Markovian model? And there's a couple of things about this that I don't understand, but basically they go through all, some equations of, here we go. The 4-factor Markovian model. Oh man, it gets really complicated, right? I read this all like 2 days ago, and like it was a hard read. I was falling asleep at parts of it, but it's like super exciting. Okay, so I went past. Okay, so so the dynamics of the instantaneous volatility reads. So that's another interesting thing about it, is that they can come in and they can say like, well, what's the VIX should be like right now at this moment, which is kind of cool. Yeah, and then they compare to other models. But because it's kind of these different parts, so there's the convolution matrix. But here's what I think I can do with the convolution matrix is, for giving you an indicator for it, is that I can come in and I can say, run it over a test set, right? Run it over a training set, okay? And then save that convolution matrix out to a file and put it on a web server somewhere that's where your clients can download it, right? So because you guys don't want to be doing the machine learning part while you're trading and everything, right? So we'll just run the training one time on my machine for a bunch of different assets that you want to use, and then set up a web service that requests the convolution matrix for the specific asset that you can use. That looks disgusting. I mean, I think that when they're trying to prove to you the math of it all, that it ends up being a little bit more complicated looking than it actually is. I think that in terms of programming this, that it's not actually that much code. So it's kind of cool. This guy says no. I should finish eating this oatmeal. Oh, most papers aren't that much code. Yeah. I think it's like I've found that to like fully explain and prove the math of something takes a lot more space on a page than an actual piece of code was. You know what's really frustrating to me on this one? So I think somewhere in here they even mentioned that they're using Python. Yep. For each model, we minimize the mean squared error on the training set using the trusted region reflection algorithm of the function least squares from the SciPy module in Python. So they're even telling you which machine learning model to use and all of that to get the convolution matrices. And I'm just like, okay, so why don't you just give us the code? Right? Oh, Python shows up in this document another time. Where is it? Oh, fundamental algorithms for scientific computing in Python. Blah, 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 blah. I mean, if this model just matches VIX volatility, you can just conclude that VIX is good for adjusting volatility as price moves. Yes. Well, so I think that the whole point of it, Kyle. So here's the thing: is they compare it to Garch here, because if you are and it's instantaneous. So like the whole thing is, okay, you know what the VIX is, but if you're trying to price options, right? What should the price of the option be? And the more effective of an estimate that you can make, the better you can price your options and the more money you're supposed to be able to make, essentially, right? So if you can calculate it yourself and get something that's more accurate and more granular than the VIX, then that's an advantage. And the advantage of this particular algorithm in particular is that once you've got the convolution matrices figured out, it's very simple, right? So like there's like Garch is like a 4-factor sort of a thing, and it's like really complicated to calculate. You can calculate this one faster and it's more accurate. So that's why this is considered a really big development. Because it basically means that you can get an advantage over other algorithms and pricing options. Yeah. It's really cool. I think it's really cool. And I kind of want to write it, but there are some things, because I haven't done a whole lot with machine learning. All I've done is like take other people's code and run it. So to write this myself is going to be a little bit of work. And we got some other things to do. So I was saying earlier that I need to make the PDF. Let's do that. Put that on my list. I'll put it in there, and then I can make it like, okay, if you want to download the indicator suite, you have to put your email in first, and then it will send you the PDF and the download link. And then you can trial it for 2 weeks, and if you want to buy it, then you buy it. That's what I need to do. I got everything pretty close to set up to doing it. I closed the spreadsheet. I'm not opening it back up again. Okay, so there's been a lot of volatility over here in the treasuries while I've been yapping. I'm still okay with my decision to not trade this live. We do after the top of the hour. So at the top of the hour, we have pending home sales, which will be really interesting, given some of the numbers that we had yesterday, right? But then after that, we also had Fed's Bullard and Fed's Powell speaking in about 30 minutes. So that could bring more volatility, particularly to the interest rate markets. And looking at the S&P 500, at least for the first little bit of the action here, there has been some buying off of the open. And that's where we're at. The dollar is coming back a little bit now. No, Evernote, you updated yesterday. Stop it. Stop it. Dear Evernote, you don't need to update every day. Oh, okay. Raroslav, please remind me, how did you find that his central bank is pushing ZN up? I was away for a bit. So I think I first, well, I read about it when I woke up, right? When I was doing my morning reading. And I think that the best story I found was on Zero Hedge. Kind of funny, because Zero Hedge always kind of distorts things. Oh, you know what really pissed me off, by the way? Let's come over here and look. Because Bloomberg, gave me their morning thing. Like my phone gives me a notification. And their morning thing didn't say a thing about it. I was like, what? Yeah, they still don't have anything about it. What the hell, Bloomberg? A central bank literally come in, restart QE, and there's not a darn thing about it on your page? There's not a thing about it on your, like, what? What are you doing, Bloomberg? Why do I have you? Okay, look, CNBC has it. It's not the headline story. Their headline story is Apple, of course, but it's not the headline. But I think that the best synopsis of it was at Zero Hedge, right? So here's the story. Bank of England capitulates, restarts quantitative easing due to significant dysfunction in the bond market and material risk to financial stability. And I think that they even link somewhere else. Bank of England, and then here they even link to the Bank of England announces gilt market operation. Right? And then there's the news release about why they're doing it and everything. Have you tried? No, I don't. I'm not sure what that is. That sounds like some... Oh, is that like a replacement for Evernote? Yeah. Okay. Let's read it. I haven't heard of that before. Which is better in 2022? Whether it's jotting down meeting notes, reminders, or a quick ramen recipe your colleague gave you, notes are a part of your everyday life, and taking notes is easy. What isn't is discovering an excellent note-taking app that fits you just right. No worries, we got you. We'll help you pick the right note-taking app as we compare Notion versus Evernote, and even highlight a great alternative to both. Oh, okay. The main difference is that Evernote is a note-taking tool that allows users to keep their files organized in one tool, whereas Notion is an all-in-one project management tool that helps you keep your notes and work all in one space. Ooh, that sounds like too much. Notion templates, code blocks, that's cool. Boards, real-time collaboration. Evernote, the web clipper. Yeah. Document scanning, audio notes, storage, Notion. Blah, 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 blah. I kind of like the thing I hate about Evernote is like it was like a really great application. And then they started trying to make money from it, and they just annoy the crap out of you. It's like, hey, every day you should buy the premium version for $7 a month. No, I'm not going to pay $7 a month for something that I can do with a piece of paper. Yes, it's not in the cloud, but gosh, no, it's not worth $7. Dum-ba-dum-ba-dum-ba-dum. Neither is ideal. ClickUp. ClickUp is the world's highest rated jot down notes with Notepad. There you go. Create knowledge bases with thoughts. There you go. No. You know, if it was only when I'm doing stuff at my desktop, maybe I should just start putting everything in Visual Studio Code. But and that was another thing that pissed me off, is like I would love to enter notes to Evernote through Visual Studio Code, but they like changed their APIs so that you can't do that. But you know what? Like I've shown you guys this before, but I've taken to, if I need to actually do something, okay? Like I'm trying to remember there's a task and I don't want to forget, and it's any kind of like near or medium term task. I write it on a sticky note and I put it on this little, you know, it's one of those clipboards, right? It's plastic, so the sticky notes stick to it really, really well. I don't know what causes these wet spots to form on the paper, but whatever. So I wrote it on there. See, I need to write the documentation and do a webinar. There's a bunch of scripts that I'm writing right now. And then I need to write a PDF document with some strategy stuff. So that's kind of how I do it. And the stuff that I put in Evernote is kind of more like I want to write something down and I'm maybe going to remember it or bring it back up like 6 months from now or something like that. So that's what I put in Evernote. Like I have a list in Evernote of video ideas. That sort of thing. Oh, look at that. Treasury's coming almost all the way back to my entry. Good thing I took profits on most of my contracts, right? Let's assume inflation stays high and interest rates go well above the neutral rate. Do you think there is another tool the central bank has to tackle this scenario? I have to think about that. I think I'm going to say that I don't think there is a tool that the central bank can use that would prevent pain or would avoid pain. Obviously, if there was such a tool, they would probably be using that now instead of interest rates. But like if things go crazy and they're still not tackling inflation, what do you do? You know, given past moves and stuff, I'm not sure that there really is a whole lot that you can do as a central bank, at least. And again, there's really nothing you can do that would avoid pain. I think that in order to deal with inflation, it requires some pain, like somebody loses money, in other words. And I would go further to say that their central bank is not the only one that can do something about inflation, though, right? Because you can do something about inflation on the fiscal side. The fiscal side caused inflation. The fiscal side can solve inflation. The problem is that the Biden administration has basically taken the tack of, well, we didn't do anything wrong. We're not going to change anything. This is basically what they've been saying. And like when there's, so like yesterday, before I went to sleep, I was reading some stuff and there was like some comments by the Biden administration that were basically like, well, we're not too concerned by moves that we see in currency markets. So it was basically like, screw you guys, we're not doing nothing about it. I think that might have been a factor behind why the Japanese acted last night. Could be wrong, but Jermax, I love Seth. Oh, Jermax. I'm married though. Passionate like me about trading and reading research journals. Use yeah. I appreciate you not putting the B on the end of that. I've used Sci-Hub on occasion, yes. Although, you know what? As of late, what I have found is that for quantitative finance in particular, that all of the best papers get put on archive.org first. So it'll get put on archive.org and then there will be like comments and they'll like revise the paper and stuff like that. And then it will go to a more professional journal. So you're not getting the exact same article as you might have gotten if you get on the professional journal, but especially for some of the most significant research, it has been available for free. So I've only found there used to be a journal about like trading of some sort, but and I was like, oh, here's an article I really want to read. And then I got the article and I was like, this isn't that great. So with or without pain, but how would the fiscal side fight inflation? Raises tax? Yes. Okay. So number one, raising taxes would reduce inflation. Yes, it would, because you're taking money out of the economy, right? So here's the thing. You hear all this stuff about modern monetary theory, and their basic thing is like, we should pay for services because these are all good things and we can get away with it because we're the primary currency in the world. And then, well, yeah, you're going to get inflation from that. So the way that you deal with that is you raise taxes. and you just take the money out with raising taxes. Okay, so like the actual like market mechanism, take your profit. There's only one contract. So I took 4 off up at the top. I'm leaving 1 on. I am considering, if it comes back to my entry, taking it again with maybe a second contract, but we'll see. I'm not too in my mind, I'm already out. Okay, anyways, so like that mechanism that they're talking about, yeah, that would kind of work. But what are you actually doing? Because what you're gonna put money into the market and then you're gonna take it back out with taxes. What's the freaking point of that? Oh, sorry, we're getting news. Pay attention, Seth. Pay attention. Pending home sales change month over month negative 2% versus negative 1.5. I'm also getting comments from Bostic. I guess his speech was giving us a transcript beforehand. I'm not really seeing the markets reacting to it too strongly. I hope the central banks fight inflation. I want to pay more taxes. Yeah. Anyways, think about it in the bigger picture. What are they actually doing? You print a bunch of money and you put it into the economy, and then you just take it out again through taxes. So what have you actually done? Well, what the reason why they want to do that is because they want to control where the capital is allocated. Really, that's really what it's about. And that probably would mean allocating more capital from the financial system, which is kind of funny. Because those modern monetary people hate the banks, and they think that the bank, of course, those guys would probably love to get rid of the banks and just put the money directly into people's pocketbooks or whatever, right? But what it essentially allows them to do is to control which portions of the economy get the money. Because the way that things work right now, you know, the central bank doesn't print the money. The member banks print the money. The member banks say, okay, this guy has a good business idea. We'll give him a loan for that. And we can afford to do it because we have enough reserves. And so they print money. That's how that works. So the real purpose behind modern monetary theory is that the left doesn't like how capital is allocated by the free market, and they would like to allocate it in a different way. Well, what does that tell you, right? Because if the market tries to allocate capital in the most efficient way, then you would only want to take it away from the free market in order to allocate capital less efficiently, right? Of course, there's like cronyism, and lots of people get money that probably shouldn't have it. But I promise you, it'll be 10 times worse if it's the government doing it. Okay? That's really what modern monetary theory is all about. Now, there are some other issues with what they're doing and what they're talking about. Okay? Like your currency and the bonds and everything would do things that you're not going to like. And other countries, like what we're seeing right now, they're going to do things that you might not like, right? But to the point that we were talking about, does raising taxes reduce inflation? Yes. Yes, it does. And depending on where you tax would affect how much of an effect it has on taxes, right? You think I could make a YouTube short just out of that clip? I don't know. I felt like that was a little disjointed, but I don't know if it's really that interesting to anybody else other than the whole point of modern monetary theory is to allocate capital less efficiently. Yeah. Basically what it comes down to. Redistribution and taking. Here's the thing is I gotta be a little bit strategic about how I piss off the modern monetary theorist guys, because they have this huge media establishment behind them. I'm telling you, if I came in and I was like, I'm a day trader, and I totally think that modern monetary theory is the best thing ever. I've read all of that lady's books, and this is so great. And I totally played into the left narrative. I would be 10 times more popular than I am. No question in my mind. Maybe I should do it. Should I do it? Should I pretend to be a modern monetary theorist just to see how much support I get from it? And then I can turn around and be like, psych, you guys are all stupid. None of this stuff will work. It's a terrible idea. Mr. Bond is like, Seth, he's seeing the sim come back and it bothers him, huh? Do it. You don't want to buy more at 22? Or did I miss something that's making this all reverse? From what I'm seeing right now, what I seem to see is like, it looks like the buying is over and that we may be in the post meta order rebalancing period. It's time to bring spec. Wait, hold on. Goodbye credibility. What? Because I'm going to become a modern monetary theorist show? Yeah. Can get hired by the Young Turks or something, and here's what I'm wondering is like I'm here I am, I'm an independent conservative commentator on markets is really what I am. I mean, I don't like, my stream is not about being conservative, but probably a lot of liberal people will get driven away by some of the things that I say sometimes. Why is like the Daily Wire or somebody, you know, like I see these people, they took an economics degree and graduated, didn't go into the industry. So there's this one girl on the Young Turks, and that's basically what her story was. She went to school and she's like, oh, I really like this modern monetary theory idea. And so she became an influencer for modern monetary theory. She never worked in the industry. It really shows, by the way. All the time she will say things about how inflation is working and so on and so forth. That is like, you've clearly only done this from an academic perspective. But I digress. So why, hey, Daily Wire, Benny, Mr. Shapiro, give me a call. We'll work something out. I would love to work. Would love to work with you. And remember, if the UK prints money, we won't be poor. Oh man. Okay, so here's the thing that I wanted to show you. Sorry. Oh, I was searching something because I forget what the Cantillon effect is. Is an uneven change in relative prices resulting from a change in monetary. Oh, yes. Okay. So I wanted to rant about something else. Okay. Well, let me rant about something else. So I'm over here on Futures.io. There's this interesting thread on Futures.io about order flow. And Futures Trader 71 actually like posted his recent webinar in it. And I'm like, so can I post my videos on the forum now too again? Because I got shit for that last time. I did it. It's okay. Doesn't give me that much traffic anyways. So I went and but there was an interesting thread. And I'm like, well, there's something y'all's missing, okay? Because you're all focused on charts. Guys, there's more to the markets than charts. So I wrote this thread, and you know, you've been around, it'll sound like the stuff that I say every day, right? Markets are very statistically efficient, which means it's very difficult to find an edge from looking at a chart. If a consistent pattern is found, it is quickly removed from the markets by people trading on the signal, and the end result is that it's difficult to distinguish from a random walk. When confronted with this reality, I often see traders react, well, if that's true, then why bother trading at all? Guys, it is a sad state of affairs when traders cannot imagine anything beyond their charts, okay? For the same reason that markets are very statistically efficient, they are not very informationally efficient, meaning that the current market price does not reflect all available information. Every trade has impact, and many of the largest trades have no informational content behind them. Instead of the volume being a vote on the state of the economy, it could just be the fund rebalancing. Such volume is essentially random, but it still moves price far from fundamental value. In other words, there can still be information that predicts which direction markets will move that day that isn't fully priced into markets. The most abundant source of edge available to retail traders today is based on what they know about the markets. What affects supply and demand in the market? What is the current state of the economy? What are the major research analysts projecting? What is the current market sentiment? Are there economic releases today? What breaking news might be lurking out there? How do large funds manage their investments? How do market makers hedge their options positions? And yet, such discussion is almost always completely absent from the popular trading discussion forums. Instead, the trading community has become a cargo cult, chasing after the past performance of technical analysis traders that, for all we know, just got lucky. Far too many words have been wasted on discussing the movement of a random line that could have been spent learning about the actual business of the market. That's my post. Right? And then what happens is some guy, I don't know who this guy is. I'm not looking to pick on him in particular, but like, you just know it's going to come by, right? And here this guy, he comes in, and what does he say? He's like, the minute I stopped reading news, sentiment indicators, closed zero hedge for ideas, and started measuring my own trading, that is when I made the turn from scratch or boom/bust to consistent. Right? The first post is some shithead saying, hey, I just completely trade off of technical analysis and make money from it. And you can too. You just got to, where is this like, I took a random walk in random lines and turned that into a statistically significant style of trading for myself. The largest source of edge is my psychology. It's so exacerbating, guys. Because I feel like I'm giving away the whole game. Just like, this is how the market really works. And if you understand this, you stand so much better of a chance of being able to be successful from this. And then first person that comes along, listen, if you want to make money, the key is know as little as possible. earnings, the economy, the federal. I don't want to know this stuff. All you need to know is what is the chart doing? The chart is going to tell you everything. And you just have to find, listen, guys, if you look at it long enough, you're going to find the pattern. There's a pattern. You just have to look at it long enough and you can be successful like me. That's all you got to do. First effing post. It so pisses me off. And that's like the only comment on the thread. I'm sorry, King Oliver. I'm not like trying to bully you or anything. I find it so flipping frustrating that the first person that comes along just ignores everything that I said and says, nah, you guys should continue to look at technical. I know that 80% of you guys are losing money from using technical analysis, but trust me, you just haven't found the right pattern yet and you can be successful with it. You say that you're profitable, prove it. I haven't posted anything about it because I know how this goes, right? You know how this is, Bob. I don't know if Bob's out. Somebody's going to send it to him and Bob's going to come back and look at this and you can have a good laugh about it, Bob. Because I know what happens if I were to post in this. I would say, okay, prove it. And then he would say, well, I don't have to prove it. I'm not going to show you broker statements. Why would anybody do that? And then I'll argue with him, and Bob will come into the thread and get mad at me for starting an argument. You know that's what will happen in that thread. So yeah. Matt is it was Matt. Listen. We know Matthew. Matthew's a good guy, and Matthew, he thanked my post too. So I'm gonna give Matthew the benefit of the doubt. But like seriously, guys, what the hell? What am I doing wrong? Is it just the case? Is it just the case that humans are wired and predisposed to want to look at the chart and not to doing real research and reading analyst reports and understanding the news and so forth? That's just the way that people are, and it's pointless to ever even bother trying to share that message and try and convince people. But then I come here into the stream, and there's so many of you that seem to get it, and I'm not, I don't see all of your guys' performance, but the fact that you keep coming back and you keep messaging me with ideas and showing me the things that you're doing, people that have now been around for several years when most traders give up after 6 months, right? Suggests to me that something that we're doing is effective and works and is worth doing. It's so frustrating that it continues to crash into the wall of resistance anytime that I try and go towards a larger audience on this idea. Like, what are you gonna do? I was a good post, right? I thought it was a good pontification. I thought this is gonna be good. Somebody on Futures.io is gonna read this and they're gonna go, oh yeah, this guy is right. I should be reading the news and stop paying attention to the chart so much. The very nature of your content is niche because futures are zero sum and it's impossible for the majority of people to make money. So if you have the best chance, you'll be mostly alone. Yeah, well, that's what I said on my TikTok the other day. So as I said, look, the social trading on social media has always sucked, because if anybody pulls something out that works and is popular, then it will stop working, right? And so the only stuff that can never be popular, it will always end up being people that are just telling you what you want to hear rather than what's effective, right? And I guess what you're saying is that the reason that my content will always be somewhat niche is because it is too good. It is actually some real useful market information. That's probably true to some extent. But I do believe that there will always be room for me to grow. So like the thing is that when I started this channel, I didn't expect 8,000 people to start subscribing to me. Like that's really kind of crazy to me, that and that there's, you know, a dozen people. Okay, like man, people's perceptions can get so out of whack, because you'll have people that will come in here and they'll be like, you know, like especially when they're trying to have an argument with me on TikTok. Like, well, there's one time this absolutely bat shit crazy insane feminist that was talking about inflation that she knew absolutely nothing about, and so she ratioed me, and they're all like, oh well, you see, you don't have anybody there or anything. They don't understand, because they're looking at this perspective of like, oh, here's this influencer that has 2 million people and you only have 8,000. They don't realize that for the kind of content that we make, that 8,000 is just absolutely crazy. And there's no way in my wildest dreams that I thought that this content would take me that far. And I think that it's such a strong base that as we continue to make more content, and if we continue to make content that's valuable to people, and we look for ways to make that content more valuable to a larger group of people, that the channel will continue to grow. And yeah, there will be some of these videos like the inelastic theory of markets and so forth, and all of the trading stuff that will still kind of have a small niche audience and won't get nearly as many views as some of these other videos that are more popular. But that's okay, because that means that you guys can still continue to use that stuff to your advantage, right? Is because looking at a chart, knowing when to buy and sell without having to get involved with the financial news and thinking of what to do, that's what the guru is used to bringing people who aren't interested in markets. Okay, and then Vibe says, do you have some material on news related to bonds or something? I don't understand it a lot, or some books or anything. That's a hard thing, Vibe, because I think that one of the difficulties is that understanding what can predict order flow and what is breaking news, a lot of it is context, right? So the first recommendation that I would make to you is to read articles on like Zero Hedge. Zero Hedge is probably the best free place that you can go and read this stuff. Especially, now there's lots of bullcrap on that website, by the way, but especially if it's an article that is like an analyst report from like Goldman Sachs or JP Morgan or Nomura. Okay, those three in particular, it's like you want to read everything that comes out of them. Okay, and yeah, our analysts are wrong all the time, but that's going to give you the context to understand what is the current like state of the economy, what are the arguments that people are making, right? And that enables you to understand everything else that happens so much better. But the other recommendation that I would make to you is that when you see something that you don't understand, come back and ask me about it, because that is why I'm here. And some of the best content that I can make is going to be the content where there's something going on in the markets that is a little bit too esoteric for the average people to understand. And they just need somebody that's that's familiar with the content to just give a brief explanation of it. And all of a sudden it's like, oh yeah, okay, that's not, because most of this stuff is not that complicated. The quantitative finance stuff, that's complicated. But most of what we have to deal with in the news and stuff is not that complicated. The British central bank is buying bonds, and so all bonds are moving up today. It's that simple, right? And the problem is that I'm not very good at knowing what the average person doesn't know. In my mind, like, everybody should know this stuff. How does not everybody know this stuff? In my mind, I look at it and I'm like, okay, here's like, Yeah, I know that I'm more informed than the average person in regards to news and that I read a lot of news, but like, surely you guys know about this and this and this. So like, I give you an example. This is kind of more political, but yesterday there's this guy, I forget his name, but basically he would protest outside of an abortion clinic, and there was a counter protester that got in his son's face, and so he responded. And my understanding is that that there was an altercation of some sort, and that it was basically like he assaulted the other protester, right? So there is a law about, blocking access to abortion clinics and stuff like that. So the Department of Justice is using this incident that happened to charge him with a federal law. And so this guy's house was basically raided by 20 armed federal agents to arrest the guy. Something when it's like, can you imagine? Oh man, 20 federal agents coming to your house over an assault case? Like, what? That's super crazy, right? And so it started to come out, and here in Utah, some of our politicians have made a stand about that, saying that it's like a huge abuse of power by the FBI and everything. I'm pretty sure that because there's been other cases where the federal prosecutors have tried to charge somebody related to this law, and the person won, the government lost. Because they said that like a one-off fight between two people does not qualify for coverage under that law, and thus you can't prosecute them under federal laws. Okay, so he's probably likely to win, right? So I know all of this stuff, right? But in the news story, they don't say any of this. They just say, well, this guy, he assaulted somebody at a clinic, and that's why he was arrested. Okay. So there's nothing about, okay, well, this is why you can have the federal government involved in an assault charge. And this is why the story is getting so much attention, because they wife posted on Twitter that they used 20 armed federal agents to arrest him. And then when they came to his door, they initially refused to show them the arrest warrant, right? They don't know any of this. Right. So I'm coming in and I bring that up, and some person is like, well, I mean, the only source we have for that is the wife. And I'm just like over here, like, are you flipping kidding me? Like, how would you even like try to lie about something like that? Like, can you imagine lying about something that 20 federal agents did? It's like, okay, like there's 20 people that were supposedly there that you could go and ask about it. So it would be kind of stupid. It would be kind of stupid to lie about it, wouldn't it? You know what I mean? But like I said, there's a bunch of information that they don't have, and I don't realize until I start talking to them and get really upset about it that they just don't know all of that stuff. You know? And so like in really, from my perspective, it's probably silly for me to get too bent up about it, right? Because the reality is that person probably doesn't follow that news too carefully. They probably don't really care too much what happens about it, and they probably don't know a whole lot about the context around it. You know, I don't know if that's a me thing or if that's just like a human thing, but that means that you guys watching this, especially you new people, especially new traders, when you see something going on in the news and you don't understand it and you ask me to explain what's going on, that is the best opportunity for content that I have. So you should ask questions. Like we've had, this week in the last, because we've had a couple of new people, we've had some really good sessions because guys have been asking really good questions. And it's not just that we're able to explain the basics, but we're also able to get into advanced stuff from that. So you're a new person and you're like already like light years ahead of other traders. It's crazy. What do we got? 30 minutes? 30 minutes left. is the U.S. turning into a kangaroo? That particular instance, I think that the Department of Justice is just being a little. They need something better to do. I don't know what's going on there. I'm a little surprised by some of the things that Merrick Garland is doing, and I'm just really glad that he's not on the Supreme Court. But that's going a little bit too deep into the political realm. I was just trying to give an example of a piece of news. I can't wait till there's a proper community of serious traders giving value to each other, like proper ideas, not this how to trade RSI divergence like Seth here, and this community sharing technical papers and in-depth knowledge. These people exist in banks and hedge funds, and they don't share with each other. What if the retail community was to share stuff? Retail will become better than all the hedge funds. Also, having everyone trading in one building next to each other is bad. You need traders to be on their own. Sometimes you don't want them all to think the same. So you bring up a couple of interesting points there. Oh, this is the oil inventory is coming through right now, by the way. Hey, look, new highs. What do you think? What do you think, Mr. Bond? Should I have puked earlier? I had no clue that it was gonna. I'm actually a little bit surprised that it's new highs. I just know that the pressure is probably gonna be up all day. You hold it. But like think about this. Think about this move for a second. That thing literally moved from 112.04 all the way back to 112.22. So that's 10 plus that's 14. That is 28 ticks. That came back 28 ticks, right? Would I have gotten such a great position if I was trading alive? It's a dangerous market to trade. Just keep that in mind. If you have a big account and you're trading this, then okay, just understand volatility is very high and this is a very dangerous market to trade. Okay, this market will destroy accounts. Are banks and hedge funds profitable traders? I heard Goldman makes their money in fees and management fees. Okay, so we got a couple of things to tackle here. So here's the first thing. Is there's kind of a larger problem with the retail trading community, because the reality is that if you are a person that is really into finance and really into quantitative finance and following the news and all of that, that you're going to go into the industry and get a job at a bank. And the only reason that you don't is because you didn't realize that was your interest until it was like way too late, right? And by that point, it's a little difficult to learn some of that stuff. So that's the reason why it is that way. Because all of the people that want to do that are at the banks, and all of the people that are doing retail trading, the reason they're doing retail trading is because they didn't want to get into that sort of stuff. It's because when they went to school, there was something that was more interesting, or they didn't go to a university, right? Because like seriously, to get into that world and to be like a big trader for Goldman, you know, a lot of it is connections, and you went to a private school and all. It's hard. It's competitive. I don't think, in all honesty, if I went back and did it all again, and instead of going into computer science, I went into finance or quantitative finance or something like that, I don't think I would have been able to get hired at Goldman Sachs. I don't think that I would have made it. I'm a little ADHD. I'm a little, what is the word? Off the beaten path. You know, a lot of my approaches are off the beaten path sometimes, you know. And a lot of people will just kind of come in, and especially when I'm giving off a stream of thoughts, that are thinking like, what the hell is this guy talking about? Like, he's all over the place, right? Some people that just really is like an immediate turn off, and especially people that are highly conscientious, and that's most of Goldman Sachs, right? It's crazy hard. So that's kind of the way that it is. Now, another thing that you said in there, Jermax, was that you know, it's not good to have everybody under one roof. Well, the thing is that Goldman is really good at having a really diverse array of people and opinions. And so you get a really good mix of opinions in there. They don't all think the same. And that's really their strength, is having a really wide array of approaches all right next to you, working with you. There's a real advantage in productivity that comes from that, right? Now, to Trading Bunny's question, are banks and hedge funds profitable traders? Yes, but they don't always make money. But what you have to realize is that how they make money is very, very different from how everybody else makes, how we have to make money, rather. How Goldman makes money is very different from how we make money. And yes, is a lot of it in money and management fees? Sure. But you got to realize that a very, very large portion of their business is just providing execution services for hedge funds and stuff, right? Like they're a prime broker. Okay. That's, I wouldn't say that's the majority of their revenue right now, but that's the thing that they've always been considered the best at, the best in the industry. Like when you're going on the quotes and you look at the level 2 quotes in the stock market, and it will show you what the quote is from all of the various prime brokers, and Goldman's is usually the best. That's why they have the reputation that they do. Okay. But they also do block trading, for instance, is one way that they make money, right? And in a block trade, what they do is somebody says, I need to sell X thousand contracts. And then they say, okay, well, this is what the impact of that trade would be. And so here's the price that we can give you. That would be a fair price. That would be better than what you can execute yourself, but would still make money for us in the firm. And their advantage is in being able to execute the orders efficiently, right? So in that situation, they're not making a conclusion about that the market's going to go up or down. Some hedge fund is making a conclusion that the market is going to go up or down, and they're just executing it for them. So they kind of have the advantage of having somebody that should know something really good about what direction the market is headed without having it to do it themselves. That kind of helps a little bit too. But you get what I'm saying? The game that we're playing is a lot more similar to what a hedge fund does, except for that a hedge fund is not typically doing intraday trades. And so even from that perspective, the kinds of trades that they're making are very different from the kind of trades that we're making. I think that the reality is that there are much less people in the industry doing the kind of trading that we're doing than there used to be, because all of the banks shut down their prop desks. So there are what we would call proprietary trading shops out there. And I'm not talking about funded trader programs. I'm talking about real proprietary trading, right? But there's not very many of them left. And even those are kind of slowly going away, and there's only if there's Axia over in Europe, and then over here we've got I forget who it is, but there's still one big shop over here in the United States. So not very many of them, right? So to your question, are they profitable traders? Yes, they're profitable traders, but we can't trade like they do. So what we have to do is different. The approaches that we have to do is different. Yeah, I think SMB is who I was thinking of. Yeah, that sounds right. You can have your own hedge fund with investors by the time you're 50, or a company, let's say Microsoft wants to hedge its cash flows for match. Oh yeah, that's a really good example, Jeremax. A really good example. I don't know if I'll ever own a hedge fund. I really want to take a Series 3 and we'll see what happens, but... Okay, on block trades, since there is price impact, is that the reason why price exhibits false breakouts and then reverses for the directional move? I'm wondering if those false breakouts as a dealer is pricing in. So, I mean, it would kind of depend on the context that you're seeing. So let's minimize this for a second and draw a picture. So if it's a quiet day in the market, right, and not much is going on, and you're trading the 10-year treasury, and it's just kind of bouncing around in a range like this, right? And people will come over here and they'll say, oh, look, here's support and resistance, right? And then all of a sudden you'll get this move that like it breaks out and everybody's like, oh, it's broken out of the range. These people all stopped out. I want to get in because this is going to trend up, and then it goes back into the range, right? That's, I think, the kind of move that you're thinking about, right? Why does that happen? So here's why I think that happens. Nothing's actually going on. So this range is mostly just caused by correlations with currencies and other related instruments, right? But there are people trading it in here. So it could be the case that there are just some retail traders that too many people get all on one side, or it could be that people are being stopped out. It could be that the market maker says, okay, well, I'm going to pull my offers here and let it come up because I want, you know, this excitement of orders to come in up here, and then maybe I can take my fills here and shift it down the other way or something like that, right? But basically what's happening is you're getting a short burst of orders that comes in, and then that burst of orders stops. Like that's all there is, because it's just retail traders or whatever. And so what happens? They will slip back into the hole that's caused by trading this range. And that's why that tends to happen, right? Now, another thing that could happen though is like you have a really big move, right? And then it kind of will do this. It'll kind of slow down a little bit, right? And then at some point it like somebody trades it the other way and it comes violently back all the way and it ends up being higher, right? That is two opposing meta orders. There's meta order 1 and there's meta order 2 there, right? And meta order 2 ends up having more impact because of the damage to the liquidity that meta order 1 did. That's why that happens. But the real, just if I wanted to take it from a more technical and empirical perspective, there is a very strong autocorrelation in the sign of orders, which means that if I see a buy right now, I'm like 0.5% more likely to also see a buy an hour from now. And why is that? And they've done a lot of investigation and they've put a lot of different models and compared them to the market. And the best theory of market microstructure researchers is that the block trades or large meta orders, as we would call them, are primarily responsible for the short-term trends that we see in the market and the auto-correlated order flow. And the market makers account for this and make the movement within that direction of which way the order flow was correlated random, so that they can still make money. So that's why when you have a move that goes up like this, you know, it doesn't just go straight in a straight line. It kind of does a zigzag line. And then you add on top of that the damage that so much volume does to the liquidity and the liquidity holes that it creates that make these huge pullbacks, right? And that's why it trades like that. It's right. It's I think to me, I don't know if anybody else that this kind of like makes a light go off in your head, but like to realize that what you see on the chart is just the result. Yeah, there is a pattern because there is this, the market reacts in a consistent way, which is to say that how orders impact markets is very consistent and can be empirically studied. It's just that you can't predict what that chart is going to look like unless you have what the future orders are going to be, right? If all you have is what has already happened, that doesn't tell you anything about what's going to happen in the future. And when I say what already happened, is like change in price and even changes in volume and stuff, right? You'd need more information like what is the current options positioning and stuff like that, right? Market makers make price random. How do they do that within the auction? Okay, so the way that they do that is basically based on, so the only thing that the market maker can actually do, if you are purely market making, now I don't think that any of these like just do pure market making where they only put limit orders out, but let's just assume that we're making an algorithm that it literally only puts limit orders out, right? The only thing that you can do is decide what price you're going to put your bid and your offer at. That's all you can do, right? So if the market is on a strong trend, then what you're going to do is you're going to make it easier for you to get filled on the bid, because that's in the direction of the trend, right? So if did you see, like when I was originally taking that trade, like say I wanted to go long right here, right? Okay, I could get easily filled at 0.5, so I can put a bid right there, right? Do I want to put a bid right at 0.2? Well, maybe not. Maybe there's enough trend that I need to make more than just one tick to justify being in a trade right now, right? And that's basically what the market makers do, is they increase their spreads based on what's going on in the market. And when they place their order a little bit further away, or they put less of them on there, or whatever the deal is, it makes it a little bit easier for it to move up, right? So this is the reason why I kind of bring that perspective up, is because a lot of people will tell you that, well, this trader, he really wants to take it as a reversal when we get to some Fibonacci level. So what he's doing is he's actually pushing the market up into here, and then he's going to smack it down around or something like that. And well, how would you do that? Because if you really want to move price like that, you're going to have to use market orders to do it, right? Now you can do that. You can come in and you can say, okay, here is a place where I think that there's going to be a lot of stop orders. So I'm going to buy price up into that location. And then when I hit that location, it'll hit their stops. A bunch more volume will come out. And then when that volume is coming out, I can use that to exit. That would be a valid trade. Sure. You can't predict that that's going to happen, though. I don't have anything that tells you that there's going to be lots of stops in a spot. Not enough to be consistently profitable with it, at least. Certainly does seem to be something that happens when you kind of break like the volatility ranges, but I digress. The price is response to randomness, not itself. Well, yeah, I mean, when you take the perspective, the order flow perspective of markets, which is that orders move price, then from that perspective, no move is random, because every move can be is deterministic based on the orders that were placed into the market, right? But when we're looking at the movement of price afterwards, there's no way to really understand exactly why it moved the way that it did. There's for all intents and purposes randomness. I mean, there's a reason that it moved that like it did, but unless you're going to go and interview everybody that took a trade there, right? There's no way to know. So for all intents and purposes, it is random. And the market makers hold their spreads so that price action kind of diffuses throughout that trend so that they can still make money on it, right? Like there still has to be people selling throughout the trend, right? And there's still going to be market makers on the bid looking to take fills here and so on and so forth. The liquidity fluctuating at different times, so price moves randomly in response to those. Yes, sure. Like something else that they might do, and I don't have any kind of models to see how you would do that, but you might come in and you might be adjusting your limit orders to try and encourage it to go up for a little bit, and then try and encourage it to go down a little bit, and ensure that there's a constant amount of movement going back and forth so that you can still get fills on your orders. Yeah. Because if it only ever just went one way, ain't nobody's going to fill you on the other direction, right? Oh, they're still coming up here at 04. You think they're going to bust another new high? I mean, this one is a little bit less clear. They are kind of hinting. I think they are kind of hinting that they're going to do it. So you know what? Yesterday we had a problem with this indicator and it never made our sound. And I think I want to come up in here and change it again. And I'm just going to say 8:55. Maybe it didn't go off because it would only go off if it was like at that exact minute. And so doing an 8 instead of a 5 is why I didn't do it. So that might mean I might need to make a change. Lots of that was a long that bit of explanation of things was like way further. So I think I missed some comments here. Radoslav, I found you a while ago, but I was still doing technical. I wasn't sure if you're legit. People are lazy and go for the easy. Drawing lines is easier than the DOM. Then I started studying what you're doing, and I was, oh, there was this guy. He was right. And here, oh, that's interesting. So you're saying you watched the stream, you heard it, and it was, you know, it didn't catch your interest. And so then you went out and you came across the empirical research and said, oh, I remember Seth talking about that. And so then you came back. That is, I've never heard that sort of situation happening before. So that's really interesting. That's really cool. Man. See what is it? What do I have to do to make that, to get that to happen to more people? Wait a minute, Seth. What if we watch how market orders take the liquidity at each price? So what do you mean by how? Maybe what I need to do is just that when I say something, I need to be showing people the study more often. Yeah. Because I think that there is a group of people that understand like what is empirical evidence and why is there studies. Because I think that the majority of retail traders believe, because they haven't been able to find it, they believe that such research doesn't exist, right? Once you know the keywords to search for, it's kind of like, holy crap, how did I know? How was I not in on this before? Because I could spend a lifetime studying this, right? Would love, you know, so like, here's a dream. Because you guys we were talking earlier about like, if I went back to school, probably wouldn't be able to work at a firm still, because I don't think that I would be like the alma mater kind of person. No, that's not what the word is. The valedictorian kind of person. I'm pretty smart, but I'm not like the top, and I have my own issues, right? But one thing that I do have is like, what if all of a sudden the YouTube channel started making millions of dollars, or somehow I just got really, really lucky and I somehow built an account up from $1,000 to like $5 million or something like that, right? And it was basically to the point where I could retire from the day job and just focus on the YouTube channel. Well, I think that at first I would have a lot of stuff to do, right? And I would want to get some employees, and I would like to get some of these other ideas that were always like, oh, this would be a good idea and this would be a good idea, and we just never have the time to do it. Yeah, sure. But I also think that at some point I would probably get bored. Like, I think that after a year of that, I would probably get bored. And so what would I do at that point? I think then it would be a really great opportunity for me to go back to school and try and get into a graduate program where I could be involved in that kind of research. I think that'd be awesome, because I have seen a couple of things in studies where I'm like, particularly with order flow, where I feel like that them having somebody like me that's kind of, because they only see it from the research side. They're not using trading programs to do this kind of research, and I could kind of try and put it into more like tradable terms for them. You know, I think that would be cool. I think that I could maybe provide some insight over there. You combine my insight with people that really actually understand the math and stuff. Could be really cool. I would love if there was just a job like that out there here in Utah or something, but I would probably have to be like in their graduate program or pursuing a PhD over there, right? Let's see here. Some price levels can be fluctuating a lot. on how the order flow is happening. Like, let's say say at 25,000 there's 500 bought but 0 sold, and at 25,000 it can be very even with 1,000 bought and 1,000 sold. Oh, I see what you're saying. So you're saying that 25,000 overall was bought, but it only happened 500 at a time versus 1,000 at a time. Sure. But I think that, like, when you're looking at this, like right now there's only like 236 contracts on the inside. Now there's only 234. Yeah, that's because the robots basically don't want to take very much liquidity there anymore for some reason. The problem is that there can be a couple of different reasons why they do that, right? For instance, one thing that you will see happen a lot, especially in the treasuries, is that this instrument ticked, but the other instruments didn't. And so that's why nobody wants to put a bid there, is because the market makers are afraid that the other instrument is going to force it to tick back down. Yes, it was the 5. It needed to be at the 5. Okay, Mike, I am thinking of getting into order flow. I've seen trading technology, CQG, bookmaps, zero charts, and Jigsaw videos. What makes you choose Jigsaw over those? There are so many choices. Oh my gosh, yeah. So, you know what, Mike? One of the things is that from one perspective, the tool that you select is really, really important, and from another perspective, it's not necessarily as important. So the reason that I use Jigsaw is because it has the best DOM. It's straight up, even compared to TT, nothing has as effective or fully featured of a DOM as Jigsaw does. And Jigsaw is constantly doing new things and providing new features that are beneficial to traders trying to trade with order flow. They haven't been as fast of developers as I would like, but they are still the innovators, and that's why I go to Jigsaw. Okay, but I wouldn't. I kind of get the impression that you're stressing about it and you're having a hard time making a decision, right? And it's not that important, right? And you know, another thing is that the costs are going to be a really important deciding factor, right? So if you use Sierra charts, you're paying like $30 a month, but that's it. If you use Jigsaw, you're paying something up front and you're paying $50 a month, right? That matters. If, you know, especially if you don't have a whole lot of free cash, then that matters. Hey, listen, if I was bringing in, you know, $2,000 a month from this or something, I might use TT instead of NinjaTrader 8 for my charts. Maybe, you know, because there are some things that are really nice about TT. Are those features worth the extra money? I think I would say so, because a lot of professionals, that's what they prefer to use, right? But is it necessary? Is it really going to make a huge difference to like your average speculator? Probably not, right? Do Jigsaw provide? Yes. So when you buy the Jigsaw package, it comes with some free training, and there are multiple packages that include even more training than that. Although I'd have to say that the training that you get with Jigsaw Independent is really good. Their videos are really good. And then I have my order flow series that kind of introduces you to the DOM, and then you just kind of have to watch it. A lot of it is experience, unfortunately. One of the things that I find really frustrating is that there are some things that I'm not sure how I teach it to you without you just sitting here with me and watching it, you know? That's how it is. Well, typically limit orders are robots, but market orders are not. There's both. So like, for instance, when there's an iceberg order, have you ever noticed that like it'll like so right now is a really good example. There's only 200 contracts on offer, and like 2,500 contracts have bought up into it. So do you really think that like that many humans are dumb enough that they all piled into the iceberg? Nah, what happens, it's a lure. There are algorithms out there that are trying to catch the edge. And so the person executing the iceberg knows that if he can just keep the offer really, really small, that you're likely to get a trickle of market orders in, and he was able to sucker 2,500 robots into trading against him from doing that, right? Oh my gosh, don't ever use Sierra. They are the hardest platform to use and set up. They have tons of features, but good luck figuring them out and customize. Yeah, that's really the truth, right? There is just basically what Sierra Charts is a programmer copying features that have been made in other platforms, and so the overall interface, it's somebody that's really smart with programming and everything, but you know, a programmer is usually not very good at like making a clean interface, for instance, right? And so like figuring out how to do anything over there in Sierra Charts is just like frick good luck. Like that's the one of the things that I think that Jigsaw has done so well at. Like it's almost like how does anybody get that good at doing it that way? Is that there's so many features, but every feature is an essential and necessary feature. There's no fluff in this program. There's not really fluff in Jigsaw. It's all like usable stuff. Well, as especially in the DOM itself, I guess maybe there's like those there's some of these things that are kind of cool, but not everybody uses, like the gauges and stuff like that. But what's a good laptop for trading? So I think that I got to get going, but in terms of laptops, you don't have nearly as many problems as you used to with laptops. If you get a laptop that is good at playing multimedia, like you can watch a YouTube video and there's no chance that you're ever going to get any stuttering or anything, then you're probably okay for trading. At least for just like regular trading. If you get into something where you're doing a lot of algorithmic stuff in the background, you really want a PC. Okay. Spot Gamma. Yeah, Spot Gamma is great. If you're going to trade ES, I think that Spot Gamma is a good way to go. I haven't used the service myself, but like there's definitely some edge to how Options Gamma works. And Spot Gamma is the most prominent provider of that service. So if you want to trade the S&P 500 and the $50 a month subscription is within your means and you're serious about it, would 100% go for it. Yeah. Okay, now I really got to go. I will see you guys tomorrow. In the meantime, stay excellent, friends. Team, stay excellent, team, because this market is a shit show. Don't blow your account, right? This is where people blow your account.